Well, hello everyone. Welcome to the Deckman Wealth Management Social Security webinar, How to Get the Most Out of Your Social Security Benefits. We have a great webinar for you today. It'll be about 45 minutes, and we'll be sending out the replay as well as the slides here either at the end of this week or early next week so that you can reference some of the topics that we discussed today. Now, if you do have a question, please go ahead and send it to info@deckmanwealth.com. We will hopefully have some time to answer it at the end. Presentation will be about 45 minutes, and we'll get to questions at the end. And if we're not able to get to your question today, we will follow up and make sure you get it answered. So here's some important disclosure information. Is everyone? Yep, there we go. Thank you for reading so quickly. And here are the three Deckman Wealth advisors. Jordan Deckman, founder and senior wealth advisor. Myself, Adam Deckman, certified financial planner, accredited investment fiduciary, and senior wealth advisor. Sam Deckman, who is hosting the webinar today, certified financial planner, certified fund specialist, and senior wealth advisor. And lastly, on behalf of everyone here at Deckman Wealth Management, we just want to share how grateful we are to have you spending some time with us on today's webinar and to be able to work with you. So just a thank you from the team.
Thank you, Adam. In addition to the three advisors that we have here, we also have 6 other folks who help and they're instrumental in terms of operations and client service, and wanted to let you know that we're a full team of 9. But before we get into the agenda, want to make sure that if you haven't already, grab a pen, grab some paper, or for those that are going to be taking notes on the computer, make sure that you have that pulled up. We are going to be going over a lot of information today. We're going to be covering a lot, and we're going to be doing it quickly. So hopefully it doesn't feel like drinking from a fire hose, but we want to make sure that we touch on a lot of very important topics. And so please write down notes. If you have questions, again, we will address them at the end of the webinar. The email, if you needed it, was info@deckmanwealth.com. And if we don't have time to cover all the questions, we will get back to you later on that. So without further ado, let's jump right in. So what are we going to be covering today? We're going to begin by talking about Social Security 101. Before we get too deep, we want to make sure we have a good understanding in terms of the basics. Then we're going to discuss when we should be applying for Social Security. Third, we're going to discuss, will Social Security be there for you? And the key part of the presentation here is going to be going over where the Social Security Trust ultimately sits at this moment. Then we'll be talking about strategies on how we maximize benefits. And then lastly, is Social Security going to be enough to live on? And how should we view Social Security in the context of an overall financial plan? So let's just jump right into the basics. There's some very important things to know, is that there's many claiming options. It is not as simple as choosing doors 1, 2, or 3. Particularly for married couples, there's 81 different ways that you can file for benefits. And importantly, they have far-reaching consequences. As we're going to go over shortly, when each spouse decides to file has far-reaching consequences, not only while they're both alive, but if and when there's only one spouse remaining. And it's very important to understand that choices impact each other. So we want to make sure that when we decide to file, it's done in a coherent strategy that takes into account while both folks are living, as well as when there's only one remaining at the end. Fourth, the system is not bankrupt. Yes, the trajectory is not looking good at this moment in terms of paying out 100% of scheduled benefits, but the system is not bankrupt, and where I'm going to explain when we get to that section. And then lastly, and maybe more importantly, friends, family, and colleagues that you work with are not Social Security experts. They may have filed personally, or they may have known someone who did something, but I can't tell you the amount of times we are asked during a meeting or sent an email about something that somebody heard from someone and the information was factually incorrect. When you choose to file for Social Security and the rules associated with it are too important to take that information at face value from other people in your life. While they may have your best interest at heart, it's very important to understand that the information may not be correct and they may have learned it incorrectly at some point down the line. So hopefully you can use this presentation to maybe correct some wrongs that you have heard, but of course, we're here to help you as well. So who is eligible for Social Security? There's really three different types. One is the worker. If you worked for a job where you paid into Social Security, you are entitled to receive a benefit. If you are the spouse of someone who worked for a job where they paid into Social Security, you are also entitled to a benefit. If you were married to someone and then got divorced, you may potentially be entitled to benefits based on your ex-spouse's record as well. We're going to go over the rules for that here shortly. And then lastly, if you are a widow or widower of someone who paid into the Social Security system, you can also be entitled to benefits as well. Now, this particular section of folks, the survivors, they have different rules than the other two. So we're going to spend, a lot of time going over different options regarding survivors. So how are benefits ultimately calculated? There's two numbers to keep in mind, 40 and 35. 40 is the amount of quarters that you need to have worked to be eligible for full retirement benefits. 40 quarters ultimately works out to roughly 10 years of service. 35 is the amount of years that they're using to calculate your Social Security benefit. So they will use the highest 35 years. So when we're talking with clients that are near retirement and we're not quite at that 35-year mark, it is important in some cases to work that extra year or two to really boost up that Social Security benefit. Because what happens is you have a year where it was zero fall away, and then we replace it. Generally, at the end of someone's career, their earnings are a little bit higher. So they're calculating the highest 35 years of your career in order to calculate what your benefit ultimately looks like in retirement. While you are working, you are taxed, and that is the money that goes into paying Social Security. And unfortunately, I'm here to report that when it comes time to receiving Social Security benefits, you are taxed on that as well. This is a chart which shows what percentage of that income is ultimately taxable to you based on what's called provisional income. This is a particular phrase which is only used in the tax code regarding Social Security. Provisional income is a special marker, which is your adjusted gross income minus Social Security. Then you add back in half of the Social Security benefit, and then you add back in any tax-exempt interest. Often this is coming from municipal bonds. So let's take the top section here, and if we look at married filing jointly. If you have provisional income over $44,000 per year, up to 85% of the income you receive from Social Security is taxable. So here we'll go through a quick example. If you receive $10,000 per year from Social Security, $8,500 would be taxable. So 85% is not the tax rate. That just means what percentage of the income you receive is taxable to you. The ultimate tax rate that is assessed is based on all of your other income combined. But I wanted to give those a chance to take a look at how it's ultimately taxed. Now, a benefit for those that live in the state of Colorado was a couple years ago, they passed a very favorable tax provision. If you are over age 65, none of the Social Security benefit is taxable for state income taxes. Now, if you live in a state that already doesn't have state income taxes like Florida or Texas, then none of the Social Security benefit is going to be taxable to you on a state basis over there. So when should we apply for Social Security? We're going to go over the filing age, what FRA stands for is full retirement age, and also the impacts. So there's three ages to keep in mind. 62 is the first one, and that is the earliest age that you could potentially file for benefits. Now, if you file at the earliest time, they are going to penalize you. You will receive a reduction in benefits. Anywhere from 66 to 67 is considered your full retirement age. You'll see us put this acronym FRA at some point in the presentation. That is referring to full retirement age. On the next slide, we'll be going over what your specific full retirement age is, and it's based on the year you were born. And so in regards to the Social Security calculation, whatever your full retirement age is considered 100%. So if you're going to file at 62, it's going to be some lesser percentage. And then lastly, 70 is the maximum age that you want to wait before you file for benefits. If you are still working, if you haven't yet filed, whatever the circumstance may be, age 70 is the absolute drop dead date that you want to file. There's no benefit to you to waiting beyond that. Now, for each year that you wait to file for benefits beyond your full retirement age, the government is giving you a guaranteed 8% increase. And I'm going to show you here in a couple slides what that ultimately looks like. But you are incentivized to wait beyond your full retirement age, and you are penalized if you file before your full retirement age. So let's quickly look here at what someone's full retirement age is based on the year they were born. So if you were born 1943 to 1954, your full retirement age is 66. If you were born 1960 or later, it is 67. And if you're 1955 to 1959, you fall somewhere in between. You're 66 and some months. So now let's take a look at how big that reduction is if you file early. So let's take a look at this middle column here first. So FRA, remember, stands for full retirement age. So if the full retirement age is 66, we can see it's 100%. And let's say they filed 2 years earlier at age 64. They're only going to receive 86.7% of what they had ultimately earned. Now, if we flip over here to the full retirement age of 67, we could see 67's 100%. But if they file at 64, they're only going to receive 80%. So it's going to be an almost 20% reduction in the benefit. So that could potentially be huge when we're thinking about the income that you're going to receive and potentially, the spouse at some point later on down the road. And so if you wanted to file at the earliest possible time, which is 62, and your full retirement age is 67, we can see it's almost a 30% reduction in the benefit. And this is something that will stick to you throughout your entire life as well. So now let's look at things on the more positive side. What if we delay filing for Social Security? What we find is that you get a 8% increase in the benefit for each year that you file. So if the full retirement age is 66, we can see that by waiting until age 70, so 4 more years, you get 8% per year. So at age 70, you would get 132% of what was promised to you beyond your full retirement age. And age 67, it's only 124 because you're only waiting 3 years beyond your full retirement age. Now, something that's important that I want to go back to the previous slide to discuss in regards to the reduction is it's not an all or nothing thing. Meaning, let's say that you can't wait until you're 66, but you're maybe 64 and deciding on what you ultimately want to do. For each month that you wait, your benefit goes up. So you don't have to wait all the way until age 65 or all the way until age 66 in order to get that next bump up in the benefit. Each month, your benefit starts to accrue. So even taking an extra 1, 2, 3 months will ultimately make a difference in the amount that you receive. So what does delaying the benefit ultimately look like in terms of dollars? So this is an example that we look at. So what we are assuming is someone's full retirement age is 67, and the amount that they would have received at 67 was $3,000. So let's fast forward and say that they're age 85. If instead that person filed at age 62, they would have received roughly $3,300 a month. However, if they had filed at age 70, by the time they get to 85, it's over $5,800 a month. So the difference is $2,500 a month more that they are going to be receiving at age 85 when they delayed. $2,500 a month is $30,000 a year. So this can be hugely significant. Now, a very important thing to keep in mind too is particularly for the women listening today, the average life expectancy for a woman in the United States is 87, 88. So over half of the women in this scenario, would certainly be better off by delaying. Now, we need to look at your individual circumstance, but it's something to keep in mind. Now, in terms of men, the average life expectancy in the United States is somewhere around 83, 84-ish. And so we'll want to be mindful there too. So what are the different scenarios for spouses? Ultimately, there's the spousal benefit, there's the divorced spousal benefit, and then the survivor benefit. So let's get into the rules of what each of those look like. The first option is spousal benefit. So this is when both spouses are alive, and the spouse gets the greater of half of their spouse's full retirement age benefit or their own benefit. So if you were working and paying into Social Security yourself, if that benefit's higher than half of the spouse, then that's the route you would ultimately go. So let's go over an example of what this looks like in practice. So John, in this example, is the breadwinner in the family. His full retirement age benefit is $2,000. Betty, her full retirement age based on her own working record is $800. So if Betty files at her own full retirement age, how much does she receive? That's right. She would get $1,000. And the reason being is half of John's, so half of 2,000 is greater than 800. And so that's why she ends up collecting the spousal benefit in this particular example. So what are some other rules to be aware of? The primary worker must have filed for their benefits. And so let's say that the breadwinner in the family is 60 and the spouse is 66. If the spouse files for benefits, she will receive or he will receive the benefit based on their working record. They are not able to collect the spousal benefit based on the other spouse's benefit until they file for their own benefits. Now, in order to collect, you must be at least 62 as well. Filing at age 62 is going to result in the smallest benefit, and at age 67 is going to be the highest benefit when it comes to spousal benefits. Now, we talked earlier about when you're filing on your own working record, 70 is the max. But when you are looking at filing for spousal benefits, 67 is the highest. So there is no benefit to waiting beyond that age. And so earlier we looked at the reduction of benefits when it's on your own working record. But to give you some context in terms of numbers, of course, the maximum that we can receive is half of the spouse. So half is 50%. So if you were to file at 62, instead of receiving 50%, it'll be some lesser percentage of that. So maybe it's 40%, high 30s, depending on what your full retirement age ultimately looks like. So now let's talk about divorced spouse benefits. They're also entitled, but the marriage must have lasted over 10 years. To be specific, at least 10 years and 1 day. You are currently unmarried, and both you and your ex are over age 62. Thankfully, if the divorce was over 2 years ago, your ex does not need to have filed in order for you to be eligible. So don't worry. You don't have to reach out to them to try and coordinate what the benefits might look like. Some other rules are that multiple ex-spouses can each receive benefits, and benefits to one ex-spouse don't reduce benefits to anyone else. So let's go through a scenario here. Let's say that someone was married to 3 separate people, each for 10 years and 1 day, and then they get remarried a 4th time. All 4 of their spouses are able to collect benefits based on their working record, and there is no reduction in terms of any of the other ex-spouses or the current worker's benefit. All of them are entitled, and they don't have to coordinate with anyone in regards to the benefit that's received. And then lastly, if you remarry, you cannot collect on your ex-spouse. That would instead switch to your current spouse in terms of their benefits. So now let's spend a moment talking about survivor benefits. When it comes to survivor benefits, there's really 2 factors that we need to be mindful of. One is the age of the deceased when they originally claimed their benefit. The longer that person waited to claim their own benefit, the larger the survivor benefit will ultimately be. Often this is called the original benefit. Factor number 2 is when the widow or widower decides to claim. If you claim before your full retirement age, then you're going to receive a reduced amount. Again, the percentage is going to vary based on what your full retirement age is. If you claim at your full retirement age or later, excuse me, the survivor benefit will equal 100% of what the original benefit was from the original individual. So here's some other rules. The marriage must have lasted at least 9 months, except in the case of accident. As a survivor, you can actually file for benefits slightly earlier. You can file at the earliest age would be 60. And if you're disabled, actually it's 50. But remember that if you're filing at 60, you are going to get a reduced benefit. Now, you can also be eligible if your remarriage before age 60 forfeits the benefit, ultimately, in terms of if you're able to claim survivor benefits. And then in terms of divorced spousal benefits, it's still available to you if your ex-spouse passes away, as long as that marriage lasted for at least 10 years. So what is the strategy that we want to employ? A rule of thumb here is you want to take the lower benefit first and then switch to a higher benefit later. So let's go through a couple different scenarios. So if the survivor benefit is greater than the benefit based on your own working record, you're going to start the benefit based on your own working record at 62, and then you're going to switch and take the survivor benefit at your full retirement age. Another scenario is if your retirement benefit is bigger than the survivor benefit, we are going to start the survivor benefit at age 60 and then switch over to the benefit based on your own working record at age 70. If you or a loved one comes across a scenario, you don't have to do this alone. Please call us. We will schedule time and we will make sure that we go through all of the different scenarios with you so you're maximizing how much you can ultimately receive from Social Security. That can be a very difficult time, and we don't want you making any decisions on your own. We're here to help. There was a very, very important change that happened to Social Security last year. We are trying to let everybody know and getting the word out, but want to bring it up again just in case those are unaware. And it was the elimination of what's called the windfall elimination provision in the government pension offset. If you were a teacher, firefighter, police officer, or someone who was not paying into Social Security, please make sure that you are paying attention and perk up right now. Before, let's take a teacher, for example. If you had the male in the household was a teacher in the para system, not paying into Social Security, and his wife was working in a job where she was covered by Social Security, he in most circumstances was not entitled to receive a spousal benefit because the pension he was receiving from para was too great that the Social Security benefit was ultimately completely phased out. That is now over. That is eliminated because of the windfall elimination provision and the government pension offset. So here's what you need to do. If you have not filed for benefits because you thought that you weren't going to receive it, please contact Social Security as soon as we are done with today's call. You can give them a call, you can go online, you can go to an office. My preference would be for you to go to an office or to process it online. Of course, you can wait on the phone, but you might be waiting for a while, and we want to make sure that you have proper documentation in terms of what ultimately happened. So in regards to the change, it's retroactive going back to January 1st, 2024. And this applies to both spousal as well as survivor benefits. Now, for those that were already receiving Social Security but at a lesser amount, you've already seen Social Security correct for this change, and you should be receiving higher monthly income. If you think that your benefit was not corrected properly, please make sure that you reach out to them and get that corrected as soon as you can. But for some folks, there's free money that we're leaving on the table that we need to make sure we capitalize on. So will Social Security be there for me? This is a question which we get all the time, and I'm glad we're going to be going over some charts to discuss the status of the system. So OASDI stands for Old Age Survivor Disability Insurance. In this system, there's more than just the retirement benefits, even though that's what most folks ultimately refer to. And so let's look at some of the numbers that we got from the report that was published last year. What we find is that the income from Social Security was 1.418 trillion, and the expenditures in 2024 was 1.485. So you saw a net decrease in the trust of $67 billion, and we still have 2.721 trillion left. That sounds good, right? Well, sort of. The Social Security Trust will be able to pay out as is at 100% of what they're promised you through 2033. They project that at some point in 2034, there is going to be a reduction in benefits. What this means is that for all people that are receiving Social Security, they will see a 19% cut in what they are currently receiving. This also means folks that are looking at their benefit estimates in terms of what's being promised to you. You are going to receive a 19% cut in benefits if nothing is done between now and then. And then we can see that in 2099, the benefit is reduced even further. Now, I mentioned I would talk to you about how the system is not bankrupt. So we can clearly see that if there are no changes made, there's going to need to be significant cuts to the system. But the way that they arrived at this 81% figure in 2034, for 60 plus years beyond that is the number that they're projecting in terms of the annual expenses that are paid versus the income that is ultimately coming into the plan through payroll taxes. And so in Social Security law, it must always be funded. And so we're going to need the politicians to ultimately get together and come to some sort of resolution. Will this happen in 2026? I'm going to say highly unlikely. Given that it's a midterm year, I think it's going to be very difficult for there to be any sort of talk, sober talk about this, because no person is going to want to be slandered by a political opponent for considering cuts in any way. So what are some strategies to make Social Security solvent? One is to raise the wage base. Not all of someone's income can be taxable to Social Security. In terms of 2026, the amount of income that's taxable is around $184,000. So if you make above that, none of it is ultimately taxed. They could choose to raise this number to whatever amount to try and shore up some of the finances. Another potential strategy to consider is raising the full retirement age. As we discussed, it was 66 to 67, depending on the year you were born, but it actually used to be a little bit lower. And so the full retirement age has been raised over time to account for increasing life expectancies. So they could continue to increase this based on people living longer than they used to. The third one is the potentially lower benefits for future retirees. A fourth one is reducing COLAs. So COLAs stands for cost of living adjustment. This is supposed to be based on inflation, but it's kind of not really. For older Americans, we find that they deal with much higher inflation than the general public, given that a lot of the expenses for old, older folks are around healthcare. And we've seen inflation, particularly for healthcare, be significantly above what we see it for regular household goods. And then lastly, they could reduce the delayed retirement credits. We spoke about how waiting each year after your full retirement age results in an 8% guaranteed increase in the benefit. So this is meaning they could reduce that to 6 or 4 or 3 or some lesser number. Now, what the ultimate solution looks like, maybe some combination of all 5 of these things, or it may include other items which are not currently discussed. But as I mentioned, there's no concrete discussion happening in Washington right now on how to make any of these changes at the moment. I'd say maybe in 2027 is when you might see something happen. But for the baby boomers on today's presentation, please know that it's not likely that your benefits are going to be reduced. And here's why. There's roughly 70 million Americans that are receiving Social Security, and the vast majority of them vote. And we are of the opinion that they are not going to vote for anyone who's going to be reducing their benefits. In terms of getting the system back on track, we ultimately do think it's going to be younger workers that will have to foot the bill. Now, Social Security is one of the most popular, if not the most popular government program out there. And so when there's been different polling on how to try and correct it, people have been willing to pay more taxes in other areas in order to keep the benefit consistent. And so again, the bottom line for boomers on today's call is I'm going to say the chances that your benefit gets reduced are not likely or small. So what are some strategies that we can put in place now to help maximize the benefits? One is to improve your earnings record. I know this is easier said than done, but it's important to say it. Social Security uses the highest 35 earnings years to calculate your benefit. So if we can earn a little bit more, particularly towards the end of your working career, then that would certainly help because we're moving off years that may have been 0, or maybe we're moving off years that were lower regarding income. Next, apply at the optimal time. This is huge, and this is completely in your control, and we can help you. I'm going to explain in just a second when we go over the analysis we're going to offer. But by looking at the least optimal versus the most optimal, that can be a difference of a couple $100,000 per year over your and your spouse's lifetime. So applying at the optimal time is crucial. Third is we want to beware of the retirement earnings test. What this means is if you are below your full retirement age and you are receiving Social Security, the government will make sure that you don't make over a certain amount if you are working for a job. And that amount's pretty low. So in 2026, if you're making over roughly $23,000, they will start to reduce your benefit. Now, once you are over your full retirement age, you can choose to receive Social Security and make as much as you want, and there's no worries. The issue with the retirement earnings test is when you are below your full retirement age. And then lastly, you want to collect more for Social Security, we need to reduce your taxes and avoid what's called IRMAA. IRMAA stands for Income Related Monthly Adjustment Amount. So the amount of money that you pay for Medicare Part B and Part D is based on the income you reported to the IRS 2 years ago. They refer to that as a 2-year look back. So for the premiums that folks are paying in 2026, it's based on the income you reported to the IRS in 2024. And as you pay more in income, the higher cost you're going to have to pay for both Medicare Part B and D. So reducing taxes is incredibly important in many different areas. And not only so you're paying a lower tax rate, but also you don't trip over the wire of these surtaxes when it comes to Medicare as well. So what are other factors that we want to consider when deciding to apply? You can see many of them here on the screen, and there's even more beyond this. But what is your health status? What's life expectancy for you as well as the family? What other income needs do we have? Are there pensions, survivor? Do you plan on working? Investments, required minimum distribution, Roth conversions, and the list goes on and on. The decision on how to file for Social Security needs to be in the context of an overall financial plan. We don't want to look at just a silo in terms of what's going to give you the most benefit, because that might not be the best solution for you. So please come in and take advantage of our free Social Security analysis where we don't have to leave this to guesswork. We can plug in the numbers and look at this again in the context of your overall plan. This is an example of what some of the charts are in the presentation that we offer. And what we can see here is that in this hypothetical example, the optimal filing strategy results in over $275,000 more in terms of retirement benefits than the least optimal strategy. And then the bottom chart here goes over what's referred to as the break-even point. Now, what the break-even point tells you, and it lets you know when you should have filed for benefits. Now, whenever clients bring this up, we always say tongue in cheek, if you wouldn't mind telling us when you plan on passing, we'll run the numbers and tell you exactly when to file. Of course, no one knows when their last day is ultimately going to be. So we do not view break-even point as a strategy in terms of making the ultimate decision. But to further explain what this means, what this is saying is that if you pass away before age 81 in this example, then you would have been better off filing for benefits sooner. But if you were to live past age 81, then you would have been better off by waiting. But what this does not take into account is in regards to spouses. So that's something we also want to be mindful of as well. Now, financially speaking, it will not be a financial obstacle if you pass away sooner than expected. But if you live a lot longer than you ultimately plan for, we need to make sure that those later years of life are comfortable for you and you have the income that you ultimately need. So we're always trying to look at things from a conservative lens of living much longer than maybe you had anticipated, because we want all of our clients to have lived long, successful retirements. So what do we need to actually run this analysis for you? We need you to go to ssa.gov and download your Social Security statement. If you haven't already, what you will do is you will create your login, and then right there at the top in the center, there'll be the opportunity for you to download the PDF. This is a great opportunity for those that are taking notes to write down ssa.gov, and then please send us an email here at info@Deckman Wealth so we can start the analysis for you. So will Social Security be enough to live on? For most people, probably not. The numbers, the statistics that we see is that roughly about a third of retirees' income comes from Social Security. So it is a huge part of what the retirement income equation looks like in Social Security. But for most folks, it's not the entire thing, and it's not even a majority. So making sure that we have the investments set up properly, making sure that we have the retirement income set up properly, make sure that we have tax management set up properly is hugely important. Now, a third of someone's income is still a major part, so we need to make sure that we're optimizing this as well. So you have a lot of questions and we can help. When should you apply for Social Security? How much will your benefit be? How do I coordinate benefits with spouses? What's the best long-term strategy for my situation? And what do I do next? Social Security is too important for guesswork. Please come in, we'll run the analysis, and we'll show you when you should file to give you more confidence. And we're going to put it in the context, again, of your overall strategy. So with that, I'm going to take a quick breather and we are going to open it up to questions. I believe we've already received a few, but if you've been holding on to it and haven't sent it to us yet, please email us at info@deckmanwealth.com. That's info@deckmanwealth.com. Please type out your questions, and if we don't have time to get to all of them today, we will get back to you soon. So, Adam, I think we have a couple. So, why don't we just get started here while other folks are typing their questions in?
Perfect. So we did get a question. It was addressed throughout the webinar, but if you could just explain again. The question is, will Social Security run out of money?
The short answer is at our current trajectory, yes. Social Security will not be able to pay 100% of scheduled benefits at its current pace. 100% of scheduled benefits will be paid through 2033. If there are no changes between now and then there will be a reduction of 19% of all of the benefits that someone is currently receiving, and there'll be a 19% reduction in all of future benefits that are being planned to someone. We are hopeful that at some point Congress will get together and address it, but don't hold your breath. We don't expect this to happen soon, especially with 2026 being a midterm election year. 2027, I think, would be the first potential time that they might start taking this seriously.
All right, have another great question here. Can I change my mind after starting benefits?
Most of the time when you start benefits, they are irrevocable, which is why it's incredibly important to make sure that we are confident in that decision before we file. However, there are some select circumstances where we can ask for a redo, if you will. I don't want to add more to your plate and sort of confuse things right now by going over what those scenarios look like. But if you think that you filed at the incorrect time and you want to see if there's strategies on how we can improve the situation for you, please reach out and let's talk about that personally.
Excellent. Next question. What if Social Security made mistakes in my earnings record?
Yes. So when you download your Social Security statement from them, on the back, you're going to see the earnings that they have reported. The vast majority of the time, it is correct. Occasionally, there will be mistakes. So if you notice that there is a mistake, please reach out to Social Security to have it corrected. They, of course, will want you to require proof of the error that was made. But I think it's a good general rule of thumb or good practice that when you're filing for benefits, just to double check to make sure that they have the earnings numbers correct. That way you can feel confident in the benefit that you're ultimately receiving.
And
All right, let's just
last
do one
question.
more.
Last question.
Yep.
This one's more related to if Social Security is going to be enough for you. The question is, what if inflation keeps rising? What happens to my Social Security?
Yes. So Social Security benefits are tied to inflation through what's called the cost of living adjustment, or the acronym there is COLA. COLAs, however, are not guaranteed. In recent memory, some of you may remember this, the COLA a couple years ago was actually zero. I know that that's hard to believe now, given the inflation we've had over the last couple years. But COLAs are not guaranteed. And in terms of potential fixes to the program, it is something that has been proposed. But right now, Social Security benefits are indexed to inflation. So over time, they will increase slightly. But something that's important to understand too is the amount that you pay in premiums for Medicare Part B and D also increase. So even if the COLA will say is 3%, that does not necessarily mean that you're going to receive 3% more, because the amount that you're going to see from the increase in Medicare premiums, will all in all likelihood go up as well. Well, thank
Excellent.
you everyone for attending today's presentation, and also really appreciate all those great questions. That was fantastic. Please send us an email if anything else comes to mind. And thank you again. And we look forward to speaking with everyone soon.
Thank you.
Bye.